All right, what is up, everybody? What is up? Welcome back. As you know, uh, this is probably my ninth video of accounting. Today, we're gonna be moving forward, guys. We're going to chapter nine. Week nine of accounting. Still in chapter eight though. Chapter eight talks about ownership, change in ownership interest. And in today's video, I'm gonna be showcasing to you one of the questions that I took from the book, from the advanced accounting book, which is P82. So I'm just gonna try to work on these. I'm gonna try to solve it in my own way. Oh, my bad. I did already. As you can see here, this is my answer. I'm just gonna guide you through how I approach this question. So let's begin. Pop Corporation purchased 480 shares of Sun Corporation common stock. They have 80% interest, and they purchased this for 10,600,000. The excess 1 million is attributed to goodwill. On January 1st, 2018, Sun sold 200 previously unissued shares for $30 per share. And then blah, blah, blah. And basically you have this table which shows you like their common stocks, paid in capital and retained earnings in January 1st and January 1st 2018, before the issuance and after the issuance of stocks. Okay, so first we are needed to calculate the balance of investment account. And so what we need to understand from this is that your equity, or the investment like account, changes because during the time you own the company actually sold some of its stocks. So again, I think I mentioned this in my previous video. Like, if you have a pool, the pool becomes less. There's less like content here, and if there's like less content, it's smaller, then the proportions of the things that you own inside the pool, it will be different too, in comparison to the new, like, to the total pool, to the total content in the pool. I don't know if that makes sense or not. So uh again, so we're just gonna go through this. January 1st, you have 12 million. So I put 12 million here, and then before the issuance you have 13 million, as you can see here. And then we have to know the difference between the two, because that itself will adjust to the investment account. Okay, so you have your initial equity account of this 10,600,000, and you want to adjust that with the difference between the equity here. And so, yes, pretty straightforward. You multiply 80% by the difference between the equity, which is 1 million, and so you will get 800,000 to be assigned to the equity account, and then you just adjust it. You add it up, and you should get 11,400,000. The reason I didn't do any of the more complicated calculation here, because the question only asks to calculate the investment account before the additional stock issuance, so before any of that stuff, which we will try to approach as we go to the second question. So second question asks us about the percentage interest after the additional stock issuance. Okay, so again, imagine you have a pool, and the initial amount of the pool was 480. So you have common stock of 480 here, but then they sold some of the wait, I'm sorry. So 480 here is the amount that they buy for 80%. Okay, so we need to know what would be the 100%. If 480 is the 80%, then what would be the total amount of stocks in the pool? And so with simple maths, you can find that the total stocks will be 480 divided by 80%, and that should give us 600. I think, let me just format it real quick. Number like that. Yeah, so you get 600 there. And so from this pool of like 600,000 stocks, the company, the parent, owns 480 of them, which makes it 80%. Okay, but then what happens if the initial pool of 600 is adjusted, in a way that this company now sells some of their, I mean, this company issues like new stocks to the pool. So if this was the initial amount, it becomes larger and there's like more stocks in it. So from 600, they add 200 new stocks, like this. The question mentioned that. So from 600, it will go to 800, right? There's an increase in the total amount. And so, but then with the increase of the total stocks, doesn't necessarily mean that your stocks as a parent will also increase. It doesn't increase that way because in the end, you still only own 480. So then 480,000 in the context of 600,000 is 80%. But in the context of 800,000, logically it'll be less, right? So then we need to make adjustments. And as I have made the adjustments here, 480 divided by 800, it should result in 80%. So now the ownership of Pop, the parent, to Sun, the subsidiary, is no longer 80%, but 60%. They still own the company. It's less than the initial amount. And so to answer, yes, it's 60%. And to answer number 3, which is to prepare the journal to adjust the additional share issuance, we should know what the adjustments will cost to the investment account. Okay, so again, imagine the pool of stocks again. Pool of stocks, it increases. So now the stocks that you own becomes less valuable in a way that you don't. I guess in this case, you no longer own 80%. You instead only own 60%. And so what does this tell us? This means that the ownership decreases from 80 to 60, decreases by 20%. At the same time, if you look at the question, the amount of total equity of the company increases from 13 to 19. So yeah, there's an increase of 6,000. Okay, but then since you're in a way that you incur the loss due to how your ownership decreases, so then you will recognize 20% of those differences, the 6,000 differences, as to be a loss. Well, I wouldn't necessarily say it's a loss. It's just like there's like adjustments to the investment account. It's not necessarily a loss. And in fact, the question said that do that if gain or loss is not recognized. Basically prepare journal entry, blah, 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 if gain or loss is not recognized. So, and speaking about that, there should be adjustments if gain or loss is not recognized. Then this is the kind of way that you want to do to make the journal entry, which you will adjust the investment in Sun account. In this case, because there's like a gain or loss, it should decrease the investment in Sun account, and so you credit it, as this is an asset account, so you credit it to decrease, and you debit on the additional paid in capital. Again, if gain or loss were to be recognized, then additional paid in capital, we would change it to something like a gain or loss from like the change in ownership. But then since it's not recognized, we just put it in additional paid in capital. Just like try to make it in a way that we are paying more towards the ownership of the company, like if that makes sense. It's like that. As for the investment account itself, you adjust it. You have 11,400 from number 1 here, as we have adjusted. There's a decrease in value because now we no longer own 80%. We instead only own 60%. And so, yeah, the investment will decrease to 10,200,000. So that's basically how I answered, how I approached this question. Do let me know if I did anything wrong or if the methods I use here were wrong, despite me getting, like, let's say the correct results. But yeah, let me know, and yeah, I am very open to all the comments. And I guess that's gonna be it for the video. Yeah, it's a short one, but I'll make another one next week. So yeah, thank you. Thank you for watching. Thank you. Thank you.